let's look at 2023 first of all, and it was dominated really by rising interest rates and a lot of uncertainty, particularly in the hotel industry, in relation to costs and operating costs and construction costs, etc. Late last year, it became clear in the economy generally that inflation was pretty much under control, and so the capital markets started to respond with the result that 5-year interest rates, which is a key determinant of value in the hotel industry, fell substantially by 75 to 100 basis points, which is mega in the capital markets. That very rarely happens over a 2-month period. At the same time, it was clear that although certain aspects of operating costs were still rising sharply, there was a degree of visibility that wasn't there a year ago, that they had stabilized, that growth had stabilized. So once one has stabilization, one can start to forecast with confidence. We also had a pretty good performance, generally speaking, in the hotel industry on the top line, with hotels generally performing well and producing revenue growth that was at or higher than expected. As a result of which, RevPAR last year pretty much is ahead of where it was in 2019. Profits are pretty much ahead, although not as much as RevPAR. And so overall performance was very good. And towards the end of the year, the capital markets really started to believe that inflation was under control and interest rates had come down. So interest rates will come down, as reflected in the 5-year government bond yields. Now, what does that mean for this year? It means that the pot of cash that is in private equity balance sheets is going to be deployed. It has to be deployed over a particular time scale in any case, and mostly private equity sat on the sidelines last year. They were pretty much out the market, with trade buyers being the dominant force last year. I would expect private equity to be back this year because unless they spend the money, they don't get their fees, and etc. And so they have to spend. And with the stabilisation that I've just talked about and expectations that inflation will fall, and the capital markets having already responded to that, it means the cost of capital has declined, which means valuations go up, which means that there's more of a meeting of minds between sellers and buyers. Well, I think you're going to see there's sort of a constant, which is sovereign wealth funds and trade are in the market. They're always in the market, right? And they will continue to be in the market. Sovereign wealth funds from the Middle East in particular, because they've got a huge amount of foreign currency to recycle, so they're always in the market. Trade are always in the market because there's synergies that they can make, which financial buyers like private equity generally can't make. The private equity community, who have a 5 to 7 year time horizon, these guys will, as I mentioned before, have to come back in the market because they've got huge amounts of capital, and they have an excuse now. They had an excuse not to do anything last year, right, because of interest rates and costs and whatever. They don't have an excuse this year, so, and they've got gazillions of capital in the balance sheet, so they will be in the market. So the question really is whether or not the clearing price with those three sort of type of buyers will meet expectations generally of vendors, and I'm pretty confident there's going to be a big pickup in transactions this year. We're certainly seeing in our business a pickup in activity.